Joining me now from our Cape Town studios to discuss the South African markets is Arthur Karras from Old Mutual Investment Group Macro Solutions. Arthur, good to have you with us today. A good starting point will no doubt have to be the retailers. We saw several of those stocks up strongly today, the likes of Foschini, Mr. Price, Clicks and Massmart. And Truworths also coming out with an interesting update, despite the fact that 71% of sales there were on credit.
Strong day for some of the retailers today. Not so much Truworths. I think the trading update was a little on the soft side, but I do think that was well anticipated by the market. I think to understand what's happening to the retailers, just need to take a step back and look at last year when we had the oil price decline by some 50%. So investors are currently saying, okay, the oil price is probably not going to fall much further, but what is the impact on the rest of the economy? And for most of us around the world and here in South Africa as well, that means lower inflation. Lower inflation means that that we're not going to see interest rates going up maybe as much as what we expected, so quite a moderate interest rate cycle, if at all in South Africa. And then importantly, a bit more money in our pockets because we'll be putting less expensive fuel into our motor cars, and the expectation is that most of that is probably going to get spent at the retailers. Hence the strong numbers of the retailers today, especially if you take into account that quite a few of them have now got dividend yields approaching 4%. So 4% dividend yield, a bit of growth looks quite attractive.
Many South African investors have been quite vocal in coming forward, saying that a lot of the cash retailers are strongly positioned, the likes of your Woolies as well as Mr. Price. Would this still remain true for the remainder of the year?
I think that is true. What is happening though is that we're starting to come to the end of the sort of negative credit cycle that began a couple of years ago. If you look at the banks as an example, and they were also strong today, the banks are currently experiencing very good credit results from their lending books, and that we think will encourage them to lend a little bit more going forward. And someone like Foschini has sold their unsecured lending business, so they're just left with a retail credit business, and we think that they'll benefit from the cycle as well.
If retailers are benefiting, it does seem as though resources are potentially on the losing end. The continued sluggish performance for commodities overall, which is also linked to the Chinese story, surely puts them on a negative footing.
The resource shares had a really tough year last year. They're one of the underperforming sectors. I think the best performing big resource company listed in South Africa, I think, was Glencore, which is down 4%. The thing about the resource shares, they've been hit quite hard. We all know the supply story. There's a lot more metal being produced and what the market needs at present. The prices have all fallen. So one's really looking at the commodity shares and saying, how much further can they fall and where's the upside from here? Maybe a slightly more positive news would be really good for the resource shares. And in some cases, people are saying, these companies are discounting a lot of bad news now, and you need to be careful about expecting further extended declines in the share prices.
What do you make then of deep value investors, many of whom have been very vocal in saying that there's an opportunity in resource shares in the long term?
The deep value story is a very appealing one. The idea of buying shares at significant discounts to what they're worth in the long term is an attractive idea. I think what has really hurt the value investors has been low interest rates. Low interest rates has pushed investors into buying investments where you have some certainty of delivery and where you have certain growth. So people are paying up for companies that are delivering steady, good earnings growth, and they are not looking at companies where there is a chance of being disappointed. An example today is Truworths. The result wasn't really bad. It was effectively a flat, real result, but the market immediately pushed the share.
Arthur, we got the breakdown from Demisha. A very solid day on the Johannesburg Stock Exchange today, market up by more than 2%. But an interesting stock that's been on everyone's lips, I'm sure, including yours, is Cecil, sitting at around 382, 384, up in positive territory. But everybody wants to know the buying opportunity in that stock. Do we need to wait a little bit longer, given the continued pressures on the oil price?
I'm not going to make a forecast about whether you should be buying Cecil or not, but what I will say is the key thing is what average oil price are you going to see. If the oil price stays at these kind of levels, it's going to hurt Sasol quite badly. If it recovers a little bit and we get an average that's maybe closer to 60, I think that'll help Sasol. But its profits are very much directly driven by the Rand oil price. So it's very difficult for Sasol to get away from that. We happen to like the story, the cost-cutting, efficiency exercise, Project Phoenix that they've got underway is quite appealing. But they can't really escape the oil price. And at a particular level, what's going to happen is that they're going to struggle to execute their big, expensive project in the US and pay a dividend. And I think that's what investors are worried about.
If resources are on the losing end, banking stocks are certainly making their way up today. Barclays Africa, First Rand and Nedbank all up strongly today. Your analysis of that, especially given the fact that financials had a really good run in 2014?
It really goes back to the same thing we were talking about earlier. Lower oil price means lower inflation, means less moderate interest rate cycle, means a bit more money in consumers' pockets, and that's good for bank customers. It means that you're likely to continue to pay back your mortgage. You might even borrow a bit more money from them, which means that their earnings are going to hold up, and they're paying good dividend yields, all of which are attractive to investors at the moment. So I think that's what makes the financial, especially the banks, attractive in the current environment.
Arthur, just to close off with the industrials, we see the likes of Naspers continually making their way forward. The SAB Miller as well, Richemont also up strongly today. Despite the concerns regarding valuations on those particular stocks, again, is that maybe where you continue to see opportunities of value?
They're all slightly different. I think South African Breweries is a global brewing company, so it's affected by what's happening in emerging and developed markets. Richemont is expected to come out to slightly flat results, but it's really high quality business that I think you can be confident in over time. And then Naspers has got another separate company specific thing that's driving it, and that is that investors are becoming far more aware of its non-Chinese internet investments, the investments it has in global classifieds, the investments it has in India, and we're starting to put far sharper numbers on those and realizing there's quite a bit of value in the business that we didn't see before.
Arthur, thank you so much for your time today and your analysis of the South African stocks. That was Arthur Karras, who is a senior portfolio manager at Old Mutual Investment Group Macro Solutions.